Welcome to our Fund and Focus series. I'm Hans Lee of Livewire Markets, and joining me today is James Nguyen. He is a senior analyst at Tyndall Asset Management and the Co-Portfolio Manager of the Tyndall Australian Small Companies Fund. James, welcome. Nice to see you.
Thank you very much for having me.
So, if prospective investors were to take a look at your portfolio from a bird's eye view, what would it say about your investment philosophy?
Our investment philosophy is to construct a portfolio of high quality companies trading at a discount to their intrinsic value. So for investors looking at our portfolio from a top down, I would hope that that investment philosophy shines through. We monitor the risk characteristics of the portfolio, and there are a couple of risk statistics I'd like to share that I think reinforce that investment philosophy. Firstly, the portfolio has a return on equity 2 percentage points or 20% higher than the small cap benchmark. The earnings growth is again 2 percentage points or 10% higher than the small cap index, and the portfolio in aggregate trades at 2 PE points lower than the benchmark, indicating that it's a cheaper portfolio than the benchmark. So it's a collection of good quality businesses that are being underappreciated by the market.
So one thing I thought was interesting reading your fund's documentation was that you are currently fully invested. So I'm curious, is that normally the case, and what does that say about how your investment philosophy is being deployed at the moment as well?
At this point in time, we are fully invested, and I think that's a reflection of our views on the market, and particularly the opportunities present in both the broader market, but I think more so, or particularly so, in the small cap market as well as the micro cap, given how much they've lagged. My simple philosophy is that if you're not invested in the market, you can miss out on some great returns. You know, if you sat on cash for the last 3 months, this calendar year to date, the small cap index is up 8%. If you've sat on cash for the last 6 months, the small cap index is up 16%. And so, you know, and our fund has done a little bit better than the benchmark. So that's sort of the type of returns you're missing. And also, in my experience, markets, move very quickly, but they do move more so quickly during inflection points. And we've really seen that in the last 6 months.
Yeah, no, understood. So, talking of small caps and micro caps here today, as we are, what do you think is the most exciting investment thematic in Australian small caps today?
I think the most exciting thematic is probably the launch of the Tyndall Small Cap Fund. But leaving aside lame dad jokes, I think just the opportunities within small caps itself versus large caps is probably the most exciting thematic in the market. If I look at the performance of small caps versus large caps since August 2021, when interest rates started going up, small caps has underperformed its large cap counterpart by 25%. But to me, that's probably not warranted in the environment we're experiencing right now. So if I look at the broader macroeconomic picture, interest rates have probably peaked, economic growth has probably bottomed, and so, you know, earnings growth is now coming through. And if I look at the small cap index, it's expected to deliver, in aggregate, over a 2-year period, a bit over 20% earnings growth versus a large cap, which is expected to deliver close to 10% earnings growth. And that's not, that earnings growth opportunity isn't reflected in the current multiples. My view is on investments. There's two key things that you need to take into account. The first is basically earnings growth, and the second is what you pay for those earnings growth. And at this point in time, I think it's just such a wonderful opportunity within the small cap index.
You know, absolutely. So your fund could have anywhere between 25 and 70 holdings at any one time. So the natural question, why is the mandate designed to have such a huge range?
Yeah, the product disclosure statement is quite broad, from 25 to 70, as you mentioned. But in all reality, when we run the portfolio, we're expected, or I would expect that we would hold anywhere between 40 to 50 stocks. The reason being that I think at 40 to 50 stocks, that's a good amount of stocks so that your high conviction positions can reflect the outcome of the portfolio in aggregate. In addition, I think having 40 to 50 stocks allows you to have enough numbers to be able to manage the portfolio risk. It also allows you to capture opportunities that the market presents. And what I mean by that is, if I recall back to the GFC, within REITs, the actual sector itself was hammered during the GFC. And the reason being that back then REITs were over-levered, in addition to credit essentially drying up. And so at that point in time, really, you didn't know which REIT would be able to access capital markets and would be able to survive. But you knew in aggregate, if you took a much longer term view than the market, and you bought a basket of these REITs, that you'd be able to make money for yourself and your investors on a 1, 2, 3 year time frame when things normalised.
So now we've talked a little bit about the fund. Tell us about a couple of high conviction holdings in that fund.
So the first high conviction holding is Webjet, which is reflected by a top 3 position in the fund. So Webjet is originally was an online travel agent business competing in the leisure market. And I think the market, or the stock market, still perceives it as an OTA, or online travel agent, which is reflected in the multiples that it trades on, very similar to Flight Centre or corporate travel. 10 years ago, the business pivoted to being a bed bank provider through its business WebBeds. So being a bed bank provider, it's essentially a technology platform that connects hotels and their inventory or hotel beds towards the distributors or resellers, be it online travel agents like Expedia and Booking.com, or bricks and mortar travel agents, or tour groups. By pivoting towards the bed bank business, this is now, or Webjet is now, a business that delivers industry-leading EBITDA margins, industry-leading return on investment metrics, yet trades at a multiple similar to its Australian peers. If I look at the international compcos, and if WebBed's earnings were put on the same multiples as international compcos, this is a business that is worth well over $10 a share, while it's currently trading at a bit over $8 a share. Qualitas is my second high conviction position, which is a funds management business operating in commercial real estate and the private debt side of things. Qualitas has multiple attributes that are really attractive to me. First being that it is a business that has been around for 15 years and it's only been listed for 2 years. And so it's a proven business model, but the market is relatively new to the business itself. It's founder-led, so its CEO, Andrew Schwartz, is probably one of the most singularly focused individuals I know and one of the most highly impressive individuals I know or have met. The other thing I enjoy or like about the business is that it's exposed to a structurally growth industry in terms of the commercial real estate private debt. If I look at that market itself, that's a $320 billion market expected to grow at 5% per annum, and the banks are stepping away from that market given the capital requirements imposed on banks. And so this has left a large gap for the private debt financiers to step in and fill that gap. Speaking to my clients, speaking to asset consultants, their view is that from an institutional perspective, this is the fastest growing asset class for the next 1 to 5 years. Qualitas is a business that's had 15 years exposure to this market, has financed over $20 billion worth of debt into this market, and in that 15 years has never experienced one default. This is a business that can compound growth at 20 to 30% for the medium term, and I think it's a great opportunity for people to have a look at it.
No, absolutely. All right, so let's close the fund and focus by talking about the technicals, because of course the technical information is very important. What type of investor is this fund suited for? What is the minimum investment for the fund, and where can I access it?
Yeah, so you can access the fund via the Tyndall Asset Management website. It is suitable, I think, for individuals who want an equity exposure, who want an exposure to the broader market and all the opportunity sets within the market, but also those that are predisposed to wanting quality in their portfolio. So what I mean by that is those that want companies that can compound earnings growth and not chase the latest fads.
Okay, perfect. James, thank you for joining us and telling us all about it.
Thank you.
And thank you for watching. You can catch more of our Fund and Focus series at livewiremarkets.com and marketindex.com.au.